Hey, what's up, guys? We're back with episode 35 of the Triotonic Podcast. I'm here with my co-host.
35. Yep, I'm here again, Andrew Carraro.
And my name is Jose Rodriguez. And we're trying to bring some good content to you guys. We're going to be reviewing some of the stuff from last week and some new things that we see on the horizon coming up.
And I'm going to try and talk Jose off the ledge. As you can see, he's on top of the building.
Yeah.
He's upset that we're turning 35. He's facing the reality of his mortality.
Yeah, I was going to do one of these. That's how I'm sure that's how all the crypto friends out there are feeling right now.
Oh, absolutely. Today was a shit show, but harvest those losses, man. If you guys don't know, the wash sale disallowed rule that applies to stocks does not apply to crypto, which means that you can sell your crypto, buy it right back, and you can still claim those losses for your cap gains for the tax year. So harvest those losses.
Yeah, harvest away, especially on Bitcoin.
Yeah.
But yeah, we have a lot of stuff in store. What were some of the things you wanted to discuss, Andrew?
So I think we should probably revisit the Atos Therapeutics play that we touched on in the last episode, Senseonics, and then we have a couple other really great candidates for covered calls. Also, gonna give you guys a nice put spread for the Nike earnings coming up. And I also have a SPAC. I know SPACs are kind of frowned upon, but I feel pretty good about this one. They got their merger meeting coming up this week. So we'll get into that as well. But I guess we can start with the Atos Therapeutics.
Okay. And right before we get started, I just wanted to say that we have some awesome ideas coming in the horizon. I'm setting up, I already had a Webull account set up that I liquidated all my assets out of. And I just deposited today $1,500 into it that we're going to start trading with live. We're going to try to get this 1,500 to 15,000. And, we have to still do the options levels on that, but maybe we could start on like some, hot like trades that we could just, and then just build it up.
Yeah. So if you guys aren't aware, being that there is, elevated risk when it comes to options trading, a lot of brokerages like to ensure that, whoever is trading on the app has that risk tolerance. So what they do is they have different levels. And, say for like level 1, you can only do simple options plays like straight up calls, straight up puts. And then level 2, you can do some spreads. And level 3, you can do condors, butterflies, and a lot more complicated strategies. So maybe we can walk through that process, just like you guys would encounter it if you aren't up to a level 3 account. And if you guys have any issues, maybe the things we encounter can be helpful to you.
All right, so now we can hit up Atos Therapeutics if you want.
Yep, let's do it. So basically, we thought it would be a good idea to, just give my history. Lost the camera there. It's all right. Give my history, my trading history, so everybody can see like the different things that we're doing, and you can see like what I'm paying, what I'm getting, and I feel like that visual aid along with my explanation will be helpful in understanding on how you make profit with covered calls. Basically, what we're going to do is just run through my history. My account history shows all the trades that I've made, and maybe that visual aid showing the profit. The credits and the debits from my account will help, to visualize how you make profit with covered calls. So you can see there on May 17th, I bought 100 shares for $325, trading at $3.25 a share. Obviously, I sold a covered call for 75. That was an amazing day. I remember it. Not too long after that, if you want to scroll up, I bought back that contract 8 days later for $34. So I made
Oh, sorry. As I said, at this point, you made $41 just holding and buying another contract.
Yep. in 8 days, I made $40, averaging down my costs just holding the shares, in addition to the market fluctuation.
So let me ask you a question. Let's say when you do the covered call and you have, let's say, you buy your 100 shares here, and when you look at your stats, it shows that your average price 325 because you have 100 shares and it was at 325. So that's what it'll show. When you buy this contract or write the contract and sell it and make these $75, does it automatically go towards your average price in?
No.
But you just keep track of it yourself.
Yeah, correct.
Okay.
So your average price is always going to stay the same based on what you paid for it, the shares on the market. But like based on your options activity, how much you're making on your contracts, and you can work that in and know how much like you're actually paying overall. But it doesn't calculate it for you.
Okay, but just in the sense of what you paid and what you've made off of it, that that's not your average price.
Correct.
Yeah, I got you. I just was wondering because like there might be some people who think that they're doing the covered call wrong and it's not showing in their average, so it won't show that way.
Additionally, when you have an open contract, like say when I wrote that $9 call on the 17th of May, that $75 went into my buying power, but it wouldn't show as a gain in my portfolio until the contract is closed. So you'll get the buying power, but you won't see that gain in the percentage or the notional gain until that contract is closed.
So which is July 16th, right?
Or you buy it back.
Oh, yeah, okay. All right, so now here you took the 75 and you bought it back for 34, so you were at 41.
Yep.
And then you sold it again.
Yep, I sold I brought it down a little bit. It was trending downward a little bit, so I felt a little bit more comfortable, selling it at a lower price. So I sold a $5 call expiring on 7/16 for $55. Just let it rock out for a little bit, and if you scroll up, you'll see.
Oh, the next one.
Yeah, my bad. Go down, and now this is when a covered call blows up in your face. As you can see, I got a little too greedy with it. I sold it a little too tight. And this was right around when Atos came out with the some good news. I think it was like a COVID test or COVID treatment or something. And basically it exploded. So in that situation, you can do one of two things. You can, accept the fact that you're going to miss out on some upside, take the premium that you're going to make and the strike price at the 100 shares. So for instance, I made $55 on that off the premium right off the bat. If I let this person execute this trade at the $5 strike price for the 100 shares, I would have made 500 off that. So it would have been $555 in total I would have made. You can accept that, say, whatever, I'm making money. I'm not going to risk anything else. I'll just let it execute. End of day, you're happy. Or what you can do is you can roll it up. So what I did is I chose to roll it up. So I got $55 for the contract initially. I wound up paying $284 to buy it back. And so what you can see what I did there is the $284 is coming out of my account. I rolled it up into another $9 call on 7/16, and you can see now I got $185 for it.
Mm-hmm.
The very next day, I bought it back for $75, made 110 clean profit.
Okay, so now let me ask you this. So if we go back here, right, and you did all right, you bought 325, you sold this here for 75. Here you're at 41, and then you sold it again. Now you're basically at $96.
Yep.
So then when like what made you decide I'm going to pay $284 for this next contract there?
Well, because I knew that the stock is extremely volatile. I mean, as you can see, since mid-May, it's been on top of the highest implied volatility charts on barchart.com.
Mm-hmm.
So I feel I can ride those trends weekly and squeeze money out of this stock. I could have also taken those $284 and just bought more shares with it, because essentially, like, what you're paying for is the share price in addition to, the extrinsic value, the theta, and the implied volatility on that contract. So, I mean, you very well could have just, said, you know what, screw it. I screwed up those 100 shares. I'll let that execute. I'm just going to buy another 100 and sell another call on it. I very well could have done that. It would have been the same thing. But as you can see, I rolled it up to almost double the price. I only lost out on $100, and I got it back the very next day.
Okay. So now here, basically, when you sell this for 185, you're almost pretty much like back at even, right? Because like you had already made $100 off selling the previous calls, so you didn't really lose 100. So you're basically back at even here.
Yeah. And then I'm making 110.
Yeah. Then you buy this 75 here, and then we start here, right?
Yep.
Yeah. Okay. So then 40. And then you buy another contract for 25.
So that's another 15 I made out of it. And then you can see I sold another one for 100.
Yeah. Oh. So down. Another one for 100. Then you paid 135 for this one.
Yep.
$6.
And then sold $10 call for 85, and that's where I am right now, just letting it rock. So as you can see, I mean, look, you can fiddle around with it, ride the trends, and try and milk as much as you want out of it, or you can set it and forget it, let it rock out, and just collect your premium at the end of the month. I don't think it's going to hit $10. It probably wouldn't have even hit $9 off that initial one that I sold. But as you can see, like I got that 110 in the span of a day. I've chipped, little gains here and there, just averaging down my costs. It all depends on how you want to play it. Like, if you're the type of trader that, wants to be hands-on and like wants to be involved, then you can ride every trend. If you're going to have a down day, you want to take advantage of that down day and buy back your contract. The thing is like, you don't ever want to roll up your contract on a down day, because when it goes up on the uptrend, you're just going to be in the hole on the covered call that you sell. You always want to sell a covered call when the stock is ripping, and you always want to buy back that covered call when the stock is on a downtrend.
Okay, so now for people watching along, I do want to mention like the limits, right? Like they can get their accounts into some sticky situations if they're trying to do too much activity in one single day. So maybe we should touch on that a little bit.
Yeah, so the FINRA regulations, if your account is valued at less than $25,000 equity, cash and stock, you can only do 3 day trades within a rolling 5-day period. That applies to stock and options. So, I mean, I'm not really buying and selling the same contract within a day span.
Yeah.
A lot of the times, I mean, I have done it before. Like I'll scalp a quick gain. I did it with Neo last week. I bought a call at market open. I sold it up 35% later in the day. But with covered calls, it rarely ever happens, because really what you're doing is you're riding the trends. And sometimes like
the time too, right? Like the time is part of the value that you're getting in the contract.
Exactly. You want to capture that theta. You want to collect the theta decay. So doing covered calls, unless there's a huge amount of volatility in the stock and it's going up and down like crazy, and you can capture those trends and milk them for all the profit to average down your costs. If it's not going to do that, then what you're really selling the covered call for is theta.
Okay. All right. So, you had a lot of action on Atos Therapeutics, and we went over that in the last episode too.
Yep. One other thing I wanted to mention about Atos is the fact that it is going to be added to the Russell 2000 index, which is the small cap index.
Yeah, and what is that event called that they do yearly? Right, it's like a yearly event. It's like the third Thursday of June. There's like a name for it when they reshuffle all their indexes.
I'm not sure of the name, but I know the Russell is owned. by the company that's a subsidiary of the London Stock Exchange. So I mean, I think with Atosa getting added to that index, the volume being traded daily could pick up significantly.
Yeah, they call it rank day, by the way. Sorry to cut you off.
Yep, yeah, no problem.
Yeah,
so I think that's going to pick the volume up on the stock significantly. Just because a lot of conservative traders, as you know, Jose, but as the viewer might not know, a lot of people just, throw a lot of their money into index funds if they're not too knowledgeable on stocks. And so when a stock gets added to an index, it gets included in index funds. And just by default, then the trading volume of a stock can pick up by being incorporated into an index. So I think Atosa has a bright future in front of it. I'm going to hold it. I got in at a really good time. At this point right now, I've already doubled my money. I've actually more than doubled my money. So I'm just going to ride it out, see what happens, and hope for the best.
All right, very nice.
And I guess the next one we should provide an update on would be Senseonics. Probably not as good as an outcome as Atosa Therapeutics, but that's what we're here for. You got to learn how to weather the storm. I got my 100 shares, $433. Same principle. Sold the covered call for 35, bought it back the next day for 15, averaged down $20 off my cost. Same thing. Now, this is where I'm going to explain certain strategies that you can use to try and get yourself out of a hole when you get into a sticky situation with covered calls. Now, when you're selling covered calls, you're trying to protect yourself against risk. You're trying to average down your costs. And your profit is obviously your average cost versus what you're going to end up selling the stock for. So when I sold that covered call on the 15th, Senseonics was trending down slightly. I sold it for $20. I didn't want to wait until it got any lower and then sell it. So I sold it, I think it was near market open, and it wasn't a very good day for the market. So what I felt like my best option would be to average down my overall cost on the 100 shares.
That's what you said here.
Yeah. So as Senseonics continued to trend down, I bought more and more shares. And then waiting for the uptrend, since I only have to hold a minimum of 100 shares, you can sell those shares. And so by averaging down your costs and then selling them when it trends up, you're making profit on the difference of the 100. So say you have 125 shares, your average cost is 433, I think it was. If it goes down, you're averaging down that 433. And then as it goes up, you're taking that profit and you're helping yourself, and you're widening that breadth of wiggle room that you have between your average cost and what you're going to sell that covered call strike at. So it's just a little strategy that I've used over some time to try and milk as much profit as I can out of these things. The only thing is obviously that could backfire on you as well. I mean, you got to be pretty bullish on it, because if you keep buying more as it falls and it never trends up, you're kind of shit out of luck.
Yeah.
So I mean, that's that. I mean, every trade is a risk. There's absolutely no, I mean, there are some trades that are zero risk or near zero risk, but there's not really that much to be gained on those.
So when you buy, let's say you said you bought more shares and you have, like you said, the number was 125, I believe. When you want to sell, when you want to buy more on a dip and you sell, you want to keep it to 100. So whatever you have over 100, you want to sell. Let's say you have 135, you want to sell the 35 once it goes up, right?
Correct.
Yeah. So you want to keep
it won't allow you to sell anything on, like it'll only allow you to sell the 35.
Yeah, because the other one is locked in a contract.
Correct.
Yeah.
And I think I know I've spoken to some people who have like this misconception that when they sold the contract, the 100 shares they held at the time were the 100 shares they had to hold the whole time, which isn't true. So essentially, like, when it dips lower than what your original average cost was, that could be, say you bought another 100 at $2 a share. That could be the 100 shares that you hold to, for the obligation of this contract. And so when it goes back up to $3, you sell the other 100, and now your average cost is much lower and you're making much more profit.
Okay. So here I see is when you sold the overage, right?
Correct.
Here on the bottom. Okay. And then, all right, cool. So then I see here there's more activity, right?
Yep. So I bought the call back, sold another one for 30. Senseonics has honestly been hitting some rocky water. It hasn't been doing as good as I had originally hoped, but that's reality. Sometimes you're going to have trades that fall apart, and you just got to try and make the best of them. You got to know if, when you should stay in them, weather the storm, or maybe if it's best for you and your risk tolerance to get out. So you can see I sold the contract last week at 30, bought it back today at 20, another $10 to average down my cost. And now I'm just riding it out. I do not have an open contract on Senseonics at the moment, because it's fallen pretty badly. And I don't want to sell a contract into a downtrend, because then when it goes into an uptrend, I'm going to be obligated, and I'm essentially losing premium that I could have collected on that uptrend if I sell too early. You never want to sell into fear. Like if you own 100 shares of a stock and it keeps falling and falling and falling, my advice would be to just weather the storm, because if it falls, say that first 10% and you sell that covered call, when it finally goes up, you're going to be in the hole, and it's going to suck, because then holding those 100 shares and weathering that storm is going to be pointless, because those 100 shares and all those gains are going to be pretty much handed over to the person you sold that contract to.
Yeah. So that's some of the ways, covered calls can backfire on you. Yeah, it's definitely an interesting strategy. And let's say for a basic rundown, like let's say I'm a brand new investor and I'm like, I have 100, let's say of, what's the other company? Regulus.
Atasa?
Let's say
Regulus.
Yeah, Regulus. Like, let's say I figured I'm like, oh, look, this stock is like at $1.50. I could buy it $150 worth pretty easily. And, I have 100 shares. Now I could practice some covered calls. Not saying that that's a prime candidate for covered calls, but let's say like in the mindset, you have 100 shares. Why would I want to do a covered call with that stock? Like what is basically, like, for the basic terms, why someone would want to do that?
So, if a stock has a lot of implied volatility, like we discussed bar chart last week, if a stock is I would say on that first page of highest implied volatility, then you can squeeze a lot of value out of the movement in that stock. In my opinion, there's two good candidates for covered calls: stocks that move a shit ton and stocks that don't move at all. Stocks that move a shit ton, you want to capture the implied volatility and collect that premium. And stocks that don't move at all, you want to capture the theta.
Okay. And then, like, let's say, like, as far as those two aspects of it, but like, why would I want to get into that? Like, doing the covered call is just to squeeze more money out and average down your cost, right?
You're averaging down your cost. You're squeezing more value out of the 100 shares that you own. If you're long on a stock and you believe that long term it's going to go somewhere, then if you're going to be holding it anyway, why not try and squeeze more value out of it?
Yeah. So pretty much what you're doing is just putting your shares to work even further than just holding it. So so someone that asks me, like, why would I even get into covered calls? It's like, if you have really strong feelings for it, you can send it out to get more money for you.
Exactly.
Yeah. So that's pretty much it. Like, just to say it to someone in a basic term, like, a lot of times it gets lost in, like, a lot of the terminology and shit like that,
Yeah,
So
absolutely.
it's just basically getting more money out of the same shit you already earn. I mean, you already own. Yeah.
Yeah, you're just extracting more value from assets that you own.
Yeah.
So, I think maybe we can discuss some other good candidates that I came across today for covered calls. As you can tell, I'm a big fan of covered calls because it's really tough to lose money doing it, and I think it's a great beginner strategy. And also, it's really tough to blow up your account doing covered calls. So the first one we'll discuss is Cosmos Energy. I actually bought this one last week, and it got hammered. Anybody who's been following the market knows that energy the past 2 weeks has been one of the worst hit sectors in the market. So I figured, you know what, like if it's hitting some really, really important support levels, there's one of two things that's going to happen. It's either going to pop or it's going to continue to slide, and I'm going to be in some shit. Luckily, the former happened today and it popped like 20%. So great.
Nice.
I sold a covered call on that one. I sold it pretty high up. So, with this one, with the price that I sold my covered call at, I think it was like near $9 or something. I would feel comfortable selling it at that. I don't really want to play around with this one too much. Atasa, I kind of want to hold long term, so I'll play with those trends. Cosmos Energy, I'm just gonna let it rock out. If it gets executed, great. I made some money. If it doesn't, whatever. I keep the premium. I'll sell another one. Another one, which I've actually been trading for quite some time, is Global Star, the ticker symbol GSAT. This one actually, they just initiated coverage on it today. An analyst initiated coverage, sees a $3 and change price target, which is about 150% upside. So I think we have a couple graphics in there with the options chain, which shows with today's movement how much that implied volatility added to the options price.
Okay, let me pull that up now here.
So as you can see, we have a bar chart. It's listed on the first page. Scroll down. You can see Atasa there as well. And then there you go. You have Global Star, 7/16 expiration. And, like I say in that little note there, you always want to use the elevated implied volatility to your advantage.
Yeah, so you see it here. Like, let's say if you're looking at Global Star, and you see that there's all the different strike prices with the higher implied volatilities right here. So like you see it here, and
Yep.
This one obviously is lower, so it's a lower percentage as well. But they're within the same range, so you have a couple to work with. If you don't feel comfortable with this strike price, you see this one, you're like, oh, maybe this one, it doesn't have the higher percentage, but it's still up there in the chart. So.
Yep, and you have with the one that's higher. Not only does it have higher implied volatility, but it's also 50 cents higher on the strike price.
Yeah.
And you'll see in the next graphic why I chose that one. So you can see there that option today increased in price 1,700%. So I sold that one, collected the $18, and the chance of profit on that trade is almost 88%. So, it doesn't really get much better than that.
Yeah. And I see
you can see
the higher you go up here, the percentage goes up on the chance of the profit.
Yep.
Yeah.
And you can see like the $2 call increased 115% in price today. That's great. Don't get me wrong, but can't hold a candle to 1,700. A little stock pun there.
Yeah, stock puns. Here we are with the stock puns. So
yeah. So Global Star, another great candidate for some covered calls. And even if you don't want to do covered calls, I'm pretty bullish on Global Star in the long term anyway. So if you don't feel comfortable trading options just yet, maybe throw a few bucks into Global Star, see what happens. If it falls a little bit, maybe average down. If it starts trending up, throw a little bit less in than you would if it trended down. But Yeah, it's a good company. They're in the communications, the telecoms sector. So I think that sector definitely has some room for growth.
Awesome.
Another play I wanted to discuss is Nike. They actually have earnings this week. And if you watched our last video, I said that I never like to buy contracts with an expiration on or about the week of that earnings, because you're really just paying for that news, and implied volatility is highly susceptible to news. So if I was to just buy, say, straight up put expiring at the end of this week, and there was barely any movement to the downside from that, I would be kind of shit out of luck, because the IV would collapse. There would be no movement, and I would lose my money. So what I did here is what's called a diagonal spread. And you can see I bought the contract, a put contract. First, let me explain that a put contract is a bearish strategy. So a call is when you think that the underlying security is going to trend up, which is bullish. A put is you're hoping it goes down. That's a bearish strategy. Now, what a put is, it's an agreement to sell a stock at an agreed upon price, where a call is an agreement to buy a stock. So if I bought $130 put, I'm hoping the stock goes down, because now me and the person who I purchased this contract from has this agreement that he is going to buy this 100 shares for me at $130. So if on August 20th, Nike is trading at $100, I'm selling them at 130. I'm making $30 profit on every single share. And so that's the basic principle behind puts. A call is you're buying them at the agreed upon price. So say that was a call, and I bought 130 strike price call on 820, and Nike went to 150. Now I'm getting them at a $20 discount, and that $20 profit applies to every single share. So just a quick breakdown of calls and puts and why they're bearish and bullish. Additionally, when you're selling the options, it kind of flips around. So if I'm buying a call, I'm bullish. If I'm selling a call, like the covered calls, I don't want it to hit that strike price. I want it to stay either trading sideways or just underneath that strike price. If I'm selling a put, I want it to go up. I don't want it to go down. So just think of it like when you're buying a contract, there's someone on the other end of that contract, and they want the opposite to happen. So when you're selling the contract, you are that person. You want the opposite of what that contract represents to happen. No, that can be a little bit confusing, but the more that you delve into contracts and start looking at options chains, the more it'll make sense. So what I did was I bought the $130 put option out to August 20th, which puts me way out past the earnings call, which is happening this week. But what I did is I sold a put that expires at the end of this week. So I'm capturing that implied volatility, and it's working to average down my cost. And if I don't get all the movement that I'm hoping for at the end of this week, that other contract is expiring at the end of this week, I could sell another one with a different expiration up until August 20th. So being that I have that one contract out to 820, at the end of this week, the $123 put that I sold expires. After that, I just have a long put. So I can sell contracts at every interval up until that 820 date. I know that also can be a little bit confusing. But again, if you just look into options chains, it'll make a lot more sense. And that also goes back to kind of like what the poor man's covered call is, calendar spread. Basically what you're doing is you're mimicking owning the underlying security, the 100 shares, because your contract is long term. And as long as you have that long-term contract, you satisfy the collateral of the 100 shares. And so you can sell against it by writing contracts, also averaging down your cost on that contract that you bought. So there's the profit and loss chart. You see that Nike's price right now is $129.50. My max profit is going to be $428.11. And my break even is even above where it's at now. So because of that elevated implied volatility, I even have room. It could even go up $1 and I would still break even. So.
Okay. All right. So yeah, basically it'll all be laid out for you. Is this why you like Robinhood more? Because it breaks it down pretty simple on these pages here.
Yeah. So I mean, a profit and loss chart is very, very helpful when it comes to options, because you see right there, like, what needs to happen for you to make your money and like what you're rooting for, you know? I mean, another great resource that I use is optionsprofitcalculator.com. If you go on there, it's linked to live market data. You put in a ticker symbol, you input your strategy, and it tells you on like every single day for every single price movement what your profit and loss would be, what your max profit is, like what your ideal outcome, perfect outcome is, what your worst outcome is, what different ways you can get out of the trade to try and reduce your risk. Optionsprofitcalculator.com is a great resource as well. Yep, there it is. And you see, you select a trading strategy. Look, they have the poor man's covered call right there.
Yep, they have these advanced ones here.
Yep, and what we're doing right now is a diagonal spread.
Yeah, so let's say like some of these, like let's say just off the top of my head, I know like these advanced ones, this is where you would need like a margin account and stuff to do some of these, right? Some, like let's say
you would need a level 3 account at least.
Yeah, so some of these like advanced ones you can't even do if you wanted to, but it's always good to learn about them, because sometimes some of those strategies can show you things that will help you with some of these, help you understand.
Absolutely.
Yeah, help you understand more like all the angles, and like sometimes some of these strategies show you what you should be doing if some of these go wrong. Some of these are like four contract strategies, right?
4-leg yeah 2-leg strategies, 4-leg strategies.
Yeah, so like a lot of
these are 2-leg
like,
strategy is 4 contracts. A 4-leg strategy is 8 contracts.
Yeah, so basically it's almost like, the way I'm trying to explain it is like, let's say when you're betting on sports, like some of these are like, like you're betting on less teams, but these are kind of like you have like 8 games set up where like even if you lose some of these, like the profit's going to work out better. It basically eliminates a lot of like your loss, right? Like it wants to just pretty much,
it gives you more opportunity for profit.
Yeah, so that's what a lot of these strategies, and of course they're all different, but they're just, I guess, different strategies. Like I know these 2 specifically you can't do without the margin account.
On Webull maybe, I'm not sure, but
on Webull.
But Robinhood, all you need is a level 3 account. And that's actually, I don't know why, it's kind of stupid on Robinhood's part, but I've seen people who like were beginner traders go to Robinhood, apply to get approved for a level 3 account and get it in a split second, which in my opinion is totally reckless, because you can blow up your account with an iron condor.
And by blow up your account, like what would happen basically?
So I mean, I guess we could talk about what happened with the unfortunate situation with that kid who killed himself. It actually happened to me over the weekend as well, but because I've been trading options for about a year now, I was aware that it was going to happen, and I was ready for the account deficit that hit. So basically when you're doing spreads, there's the contract that you sell or write and the contract that you buy. usually the contract that you sell is going to get exercised first. So let's say I have a contract on Apple. Apple's selling for, let's say, $130. If that contract is exercised, now I owe somebody $13,000 because I'm in the hole for 100 shares of Apple. That account deficit is going to show overnight until my contract covers that collateral and satisfies the obligation for those 100 shares. So if I get exercised early or on the Friday of expiration, overnight, the account deficit in my account will reflect those 100 shares unless I'm selling a covered call. This only applies to spreads. And then in the morning, when they've had a chance to settle my long leg, the contract that I bought, it'll settle, it'll be fine. I will no longer have an account deficit. But what happened with that kid who killed himself is he had a spread or a condor. He basically had a multi-leg strategy, and the short leg on one of his strategies got exercised, and he didn't realize that he didn't actually owe all of that money overnight when his account deficit showed, I think it was like $500,000 or $750,000. He didn't realize that he actually didn't owe that money and that his long legs were just being settled. If he had just waited until the morning, he would have seen that his account would have went back to normal and he would have been covered for that collateral on the long contract that he bought. So that's what I mean by blowing up your account. I mean, Robinhood, I think, has gotten very, very smart after that. They have what's called a risk check now.
Mm-hmm.
So if you have a multi-leg strategy, even a simple spread, and it's at risk of getting assigned, which means the person you sold the contract to executes that contract and wants the 100 shares or wants to sell you the 100 shares. Basically, what they'll do is they'll auto exercise your long leg to make sure that you're not going outside of your normal risk tolerance. So, I mean, it's really tough to blow up your Robinhood account now. I'm not sure how it is on Webull, but if you don't know what you're doing, you should not be trading spreads or multi-leg strategies.
Yeah, that just seems like really reckless. Like even
Yeah.
it even seems reckless, like people that aren't familiar with calls and puts. And then when you go into the options charts, there's the bid and the ask, and then also the bid and the ask for the puts. And that basically goes off of if it's going down or going up, obviously. But then even with those, definitely read up on how to place those contracts. You might be thinking that you're putting the contract in your mind the way that you want it, but you might be ordering the complete opposite. You know what I mean? You might be clicking ask instead of bid for a call, and then you're doing the complete opposite. It's really smart to just really learn about it. And
the bid and the ask spread is similar to what exists when you're just trading normal shares. I mean, it's basically just, you have market makers, the guys who connect the buyers and the sellers. The bid is what somebody says they're willing to pay for something. The ask is what, somebody wants for something. Usually there's a difference in those two prices. The market maker has those guys meet somewhere close to the middle, and the difference between the bid and the ask is what their profit is. Usually a trade will get executed faster if you bid closer to the ask, and it'll get executed faster if your ask is lower to the bid, conversely.
Yeah. So yes, I guess some takeaways from this are, people that want to get into options, just get really into the terminology. And, a lot of the confusion I think is with calls and puts is that they're kind of inverse of each other, like how you were saying before, when you're betting against the opposite things to happen. And then depending, go ahead.
So I think what it comes down to is if you're bearish on a stock or if you're bullish. I think that's the easiest way to put it into layman's terms. So bearish is you think it's going to go up. No, bearish is you think it's going to go down. Bullish is you think it's going to go up. So if you're bullish on a stock, you should be buying calls or selling puts. If you're bearish on a stock, you should be selling calls or buying puts, if that makes any sense.
Yeah, it does. Yeah, so I think like one thing that I wanted to mention, I should have mentioned it earlier in the episode, but I'll just mention it now. Oh, I did mention it about that, how we're going to set up that. I have that Webull account set up.
Yep.
I deposited the $1,500. As soon as that clears, I think by the end of this week, we're going to pick some of those picks we've been throwing out there. We're going to start putting some of that money to work. And yeah, I know already some of the viewers I talked to about this that are viewing the show. They said they're going to jump in and trade along with us with like using less money, obviously. But one of
Yeah.
my friends said they're going to do like $150 and like kind of
Yeah.
like go along with us, you know?
Yeah. And I think a big reason why I've been choosing covered calls that are kind of, penny stocks. Penny stocks are considered, anything under $5 is considered a penny stock. Is because I want people to be able to get into the trades with us, try their hand at options trading if they feel comfortable, once they feel comfortable, and try and build their skill set with trial and error. I mean, that's how I did it. I watched videos, I took the courses, I read, I did the paper trading, and then after that, I bought some straight up calls, some straight up puts. Once I felt comfortable, I moved on to the next strategy, like the spreads. Then I moved on to the condors and all that. But I think, like everybody always says with anything, you got to crawl before you can walk. So, I mean, I think, we will delve into more of like the ins and outs of simple stock trading before we start getting into the more advanced strategies. I think that's super important. I've had plenty of people, reach out and ask, about options, but I want to make sure that like we're building a firm foundation for everybody. And if there's ever any questions or anything that you don't understand, you could reach out to us in the Facebook group, Ape Logic Massive Gains. Also, I have no problem if you reach out to me personally, if you happen to have my personal info. If you don't, then don't hit me up because we don't know each other.
Yeah, and I think that's why I got the idea to do the Webull account, because what it'll do is we'll start doing some like maybe more like short-term hot stocks, like flavors of the week, like we like to say, and start flipping the money a little that way. And then once it's generating some income there, we'll fall across some prime candidates of stocks that we own already that we can use for some options, things like that, or even covered calls. If we like, let's say if we bought Global Star, that would only take up $150 of my 1,500, and then we can use them for covered calls when the time is right for that. So yeah, I think that's going to be good.
Yep. And one other thing, I just wanted to mention before we sign off. There is a SPAC, like I mentioned earlier, that I feel pretty bullish about. It's Aacq, Artius Acquisition. They are merging with Origin Materials, which is a zero carbon materials company. They have a couple $1 billion in contracts from PepsiCo, Danone, Nestle. And what their prime objective is to eliminate petroleum byproduct packaging from the market. And so I think that's kind of something that's hot right now. Everybody wants to be green. Everybody wants to get into the ESG shit. So, while SPACs have taken quite a hit recently, I think this one shows some promise. Aside from that, the implied volatility on it is super low. So I bought a couple contracts expiring June 18th. They expired worthless. Not every trade I make makes money. It's just the name of the game. I bought more expiring on July 16th. The meeting is due to happen June 23rd. Hopefully the ticker change where it goes from AACQ to the ORGN for Origin Materials happens on or about June 23rd. Once that happens, I'm hoping for a little bit of movement. If we get a little bit of movement, hopefully we see some gains. And I think it'll be something that has a lot of potential for growth. Pepsi, Danone, and Nestle started something called the Natural All, play on words, Bottle Alliance. So I think there's some promise for that one. So AACQ is the ticker. I guess we can throw it in the description as well. Check it out. Do your own due diligence. If you guys like it, you can follow along with us. but always do your own due diligence, like we always say. Don't take our word for it. Don't take anybody's word for it. Everybody should learn to do their own research.
All right. Well, that's another awesome episode, number 35. If you guys have any questions, please hit the subscribe button, hit the like, and the notification bell. That's the trifecta there.
Also, Ape Logic, Massive Gains, mention it again. Join us in the Facebook group. Jose and I, plus, a plethora of other people, post some great stuff in there, news, stock tips, just all around good stuff. If you're into stocks, crypto, whatever it is, it's a great place to get your daily fill of news.
Definitely. So that's a wrap for this episode. We're gonna be trying to do a lot more updates, and we're gonna be diving into like basics of just looking at stocks and working from there, from like pretty much the bottom up. Sometimes we've been in for a year or two.
Started from the bottom, now we're here.
Yeah. Like sometimes like we'll be having a conversation and we'll start talking about like basics and things like that, and then we realize that that's actually a little more ahead of like when we first started the basics. So it's like sometimes you got to remember like where we started from and what we didn't know, and then go back from there. So
we realize like everybody's at a different place in their trading journey. So like we discussed, what we're going to be doing is just making topical videos for different things, whether it be technical analysis, market dynamics, trading strategies, and they'll obviously be labeled as such. So depending on where you are, you can just check out our videos, see which one you need a little a refresher course in, and you can check it out.
All right. Well, that's been episode 35. My name is Jose Rodriguez, and I'm with
Andrew.
And we will be signing off. Hit us up if you need anything, if you have any questions about this episode, and keep coming back for some more. All right. See you guys next time. Later.